Hey, good afternoon, everyone.
Hi.
Hi, Professor.
Hi, Aura. Hi,
Hi.
Khalid. Good afternoon.
How are you?
So, yeah, hi. How's everybody?
I'm good.
Antonio, how are you? All right. Today's session is the last Collaborate session because Monday is our last class, but that will be our in-person
Mm,
class. So I will see you guys on Monday. Um, of course, the final is online and it will be over this weekend. Um, so on uh, Monday, there's a, reading and video assignment for Monday, and it's going to be 2 hours, so we can talk about the videos I posted. I believe you have seen it already. You can see that already. Like uh, Maybe 1300 and so reading for videos and okay. I what is so okay. That's fine. I mean, these two are more important. And this one, I want you to have. And these two videos, Money, Power, and Wall Street. That's a PBS video, and it's really well balanced documentary, and that touches the um, core of the problem. Although the inside job was more controversial, but it's a kind of biased. But anyway, what we're gonna do today is, we finished. I believe we did these two examples last time. So I want. So uh, please open this file again, right? Um, Now our next problem is row 12, and so everyone has this file open in front of you,
give me a
everyone?
second. I'm gonna open it
Yeah,
now. Sorry.
yeah, go ahead. Yeah, do it.
What file, Professor?
We worked on this file last time. Hmm? You must have downloaded it already. Which is,
Oh, I just came in. That's why I was asking.
mm, yeah, but actually, we worked on this file last time, so there was only one file there that we worked on last time, and it's this file, right? All right. So if you have it in front of you, I'll have to assume that you do. Uh, okay. Then go to row 12, right? So uh, this example is about finding R, finding rate, and then yield to maturity. Now, in the previous example, this was called APR, but again, that's the annual rate, discount rate. That's the discount rate. All the rates must be annualized. So that's why I put APR there. But this time it is called yield to maturity. Now, Do you remember that I said in our in the previous classes that um, uh, this example says, discount rate is 6%, but I told you over and over, this is this is not the way it is worded. Uh, they hardly say it this way. Problems are worded. There is no problem that says uh, this is the discount rate, right? There is no problem that words it that way. And so this is just exceptional. This is an exception. This is an exception because when I wrote this, I wanted to make it simple. But the way actual problems are worded, I told you there will be well, it will be one of the three ways. One, the bond is priced to yield 6%. Okay, the bond is priced to yield 6%. That's how it is worded. Or the comparable bonds, right, or similar bonds are paying 6%. What that means is the bonds of the same risk class. The bonds of the same risk class are comparable bonds or similar bonds. Okay. Uh, when they say similar bonds, what does that mean? Do they look similar? Huh? Whether they look similar or not, that's not, then it's the design, print design, right? The pattern design. If you take it like that, then that's not a grown-up's way of thinking. That's juvenile way of thinking, right? Because it's very superficial. I mean, you judge the bond by the design, pattern design, on its, that's obviously ridiculous, right? Uh, so similar bonds or comparable bonds mean actually, similar in its risk class, comparable in its risk class, right? That's what it means. Um, So that's the second way it is worded. And the third way it is worded is that the prevailing market rate is 6%. Prevailing market rate is 6%. Prevailing rate also, that means, the average coupon rate for the bonds of the same class, same risk class, right? For that category, for that class, the prevailing rate is 6%. That's what it means. Okay. So nothing is worded this way, right? So you have to keep it in mind. So then remember, uh, priced, the bond is priced to yield 6%. And that example was also somewhere here, I believe. No? Okay. Let's take a look at this example. The Emory Corporation issued an 8% 25-year bond 15 years ago. Okay, so if it was 15 years ago and it was originally a 25-year bond, then it's obvious. How many years? How many years are left? Hmm? How many years are left to maturity now?
10.
10 years, yes. And who said that?
Or
Okay, Aura, so you got another 0.25. I mean, yeah, listen everyone. You can even earn points for something so obvious like this. It's just if you're not doing it, you're just foregoing your own, you're just forfeiting your own point opportunity, right? Yeah, they got, only 10 years left now. Um, at the time of issue, it sold for its par value of 1,000. Oh, this is also another clue. When it was sold, right, first time, when it was sold at time zero, it sold for its par value. So then what can you tell from this? What must have been the discount rate at the time? What must have been the discount rate at the time? Anyone?
8%?
Yes, yes. And who said that?
Aura?
Okay, all right. You got another 0.25. Yes, it must have sold. It sold for its par value. Then the coupon rate and the discount rate must have been the same, right? Remember that. The reason that the bond becomes a premium bond is because the coupon rate is greater than the discount rate, right? And vice versa for the discount bond. And the mathematical logic behind it is, think about it. If the if it is discounted by 7%, then the present value of all of that will be exactly it's just like this. Think about it. Let me use this. Suppose you put $1,000 in the bank, $10,000 in the bank, and then you have the bank interest rate is 6%. 10 years later, what's it going to be? We know how to do that. Times 1.06, right? Raised to 10. That's going to be the future value of that 10,000, right? Then think about it. If you discounted, right? If you discount this by 6% for 10 years, in other words, you discount it back to present, what should it be? If you discount it by 6%, 10 years back, what should it be? Anyone? Come on, this is not a difficult question.
6%?
Yeah. If you discount it by 6% for 10 years, in other words, back to time zero, what should it be?
Oh, 600?
600?
Wait.
How can it be 600? Anyone else? Come on, you don't even have to calculate this. This is the result of $10,000 compounded by 6%, 1.06, raised to 10 for 10 years. But then if you discount it back to present by 6%, what should it be?
Okay, yeah, I get it. Okay.
So you don't even need to calculate it. You should. So who was it? Aura? You have?
It's 10,000.
Of course, it should be 10,000. Yes, of course. Isn't that right?
Yeah.
Look, this is the result of compounding, right? Compounding 10,000 by 6% for 10 years. So if you discount it exactly by 6%, if you discount it 10 years to present, then what should it be? It should be back to its original value of 10,000. Make sense? This is just an analogy. It's just like that. Think about it. If you have a bond that will generate this future cash flows, $70 per year for the next 20 years, right? And the coupon rate is 7%, so $70. And if the discount rate is 7%, not 6%, 7%, then it will be discounted back to 1,000. Exactly, it will be 1,000. In other words, it will be exactly discounted, and it should be exactly the par value. Now the reason, and when it is discounted by 6%, the reason it will become a premium bond is because it is under discounted. It's under discounted. Yeah, it makes sense. If it is discounted by 7%, it will be exactly discounted. If it is discounted by 6%, it will be under discounted. So you will end up with the present value that's greater than the par value. On the other hand, think about it. If it is discounted by 8%, then it will be over discounted, right? It will be over discounted. So it will end up with a present value that is less than the par value. Okay, that's the mathematical reasoning behind it. Also, some intuitive reasoning. Intuitive reasoning is if it pays better coupon than the average prevailing rate in the market, didn't I say discount rate? This is not the way it is worded, but the way it is worded is that the prevailing rate is 6%, or similar bonds are paying 6%. That means the bonds of the same risk class are paying on average 6% on average. Or the bond is priced to yield 6%, price to yield 6%, right? So then this is the yield, the way, and it's the discount rate, okay, of the bond. So here it is, the way it is worded, right? Comparable bonds, it says comparable bonds. Now you get what it means. Comparable bonds are yielding 10% today. What does that mean? This is the discount rate, right? And from this, you can tell, oh, coupon rate is 8%, but the discount rate is 10%. Then you can already tell, will this be a discount bond or premium bond? You can already tell that from here. Will it be a premium bond or discount bond? Anyone? Anybody? Angel? Aura? Yeah, you can go ahead, Aura.
It will be a discount.
Yeah, it will be a discount bond. Definitely, it will be a discount bond because it will be over discounted, right? Because it's paying only 8%, but discount rate is 10%. So it will be over discounted and it will be a discount bond, right? So what must Emery's bond sell for in today's market to yield 10% to the buyer? Yeah, that's asking for what's the price of the bond today, and this to yield 10%. That means that's the discount rate. That's the yield to maturity. Yield to maturity means annualized return, and that is what the prevailing market rate is. That is what the bonds of the same risk class, comparable bonds, are paying. That's the discount rate. Assume the bond pays interest semi-annually. Yes. And it's a two-part problem. Also, part B, and also calculate the bond's current yield. Yeah, then think about it. This problem, we know it's asking for, it's not exactly, it's asking for the yield. This one is asking for the yield. I'm going to do that later. But here, this is exactly our, so row 15, exactly our example. Let's take a look at that. Face value 1,000, coupon rate 8%. So coupon payment is $40 per semester, right? $40 per semester. And time left, 10 years. So 20 semesters. Yield to maturity, which is the discount rate, 10%. So half year rate. Now, of course, we know it's going to be 5%. Let's divide it by 2. There you go. And the bond price will be then, using our formula, payment over R minus payment over, open parenthesis, R times 1 plus R raised to 20n, close parenthesis. But this is only the present value of the coupon payments, right? This is only the annuity part, plus, and discount face value by 1 plus R raised to n. Okay? And hit enter. Did you all get this? And this confirms our guess that it's going to be a discount. But that guess was not just a wild guess. That the guess was a very well-educated guess, right? Isn't it right? And that confirmed our educated guess, right? So everyone got this? No? How come? Aura, you got it?
Yes.
Okay, good. How about the other people? Angel, are you there, Angel? Antonio, did you get it, Antonio? Are you there, Antonio? Antonio, I saw your microphone. Did you get it? Or your microphone is muted? Check if your microphone is muted. Chris, are you there, Chris?
Yes, Professor.
Okay, so you got it? You got the same result?
Yeah, Professor.
Okay, Antonio, you were muted. Okay, but you got it. Okay. And then Chris got it. George, are you there, George?
Yes, I'm here, Professor.
Okay, you got the same result?
Yes, Professor.
Good, good. Jacob, are you there, Jacob? Jacob?
Yes, sir.
Okay, so did you get the same result?
Pretty much, yeah.
Yeah, okay, pretty much. Okay, so there is some, partially you didn't get the right answer. What do you mean, pretty much? Huh?
No, I mean like, yeah, I got it.
Okay, Jason, are you there, Jason? Jason, Khalid, did you get the same result? Khalid, are you there?
Yes, Professor. I'm sorry.
Okay, you got the same result?
Yeah.
Okay,
Let me
good.
just double check. One moment.
Okay. Keisha, are you there, Keisha?
Yeah, I got the same answer, Professor.
Okay, good. Yosahani, are you there, Yosahani? All right, it looks like, most everybody got the same result. You're good then. And then let's take a look at another, part B. What is the current yield? Now, so here's the thing. Yield to maturity, I been, maybe did I talk about it in this class or another class, but here's what is, mathematical definition of yield to maturity. Now, this is the formula for bond, right? And then bond pricing, and usually the question is about what is this? Usually the question is, about what is the left-hand side. In other words, what's the bond price? Okay, and I use uppercase B as the notation for rational price of the bond or intrinsic value of the bond, intrinsic value or fair value of the bond. Now, as I said before, uh, unlike stock, which has a lot of uh, unpredicted, unknown variables that can go. Of course, stock valuation also um, is based on, predicted future cash flow. Uh, Stock pricing or bond pricing models are all called discounted cash flow model because you are discounting the predicted future cash flows. But in stock, there's a lot of volatility still, right? Uh, so there's a uh, relatively large variance to the value of the prices. It can, I mean, the value of the stock that is calculated by the model, by the stock valuation model, would be one, but then actual value there will be a wide variance between around the in actual value, right? Uh, Wide variance in actual values around uh, the rational price or intrinsic value. But in case of bond, that variance is relatively very small. Um, the bond the variance in the bond price, actual bond price, won't deviate that far away from its uh, intrinsic value or the rational price. It's called rational prices. It's called rational price because it's based on nothing but the future discounted future cash flow. And the discounted future, there's no unpredictability. There's no unpredictability in the future cash flow because bond pays interest. Interest is fixed. So what else can there be? I mean, over the next 10 years, there will be a coupon interest, which is a regular payment, which is constant, a regular payment, right? Regular amount paid at regular interval, right? And there's no what if, right? There's no what if. Um, that's what's going to happen exactly. As long as the bond rating is triple B and above, right? And only triple B and above are investment grade. Below triple B are risky. And if you below triple B, it's called junk bond. Junk bond sounds like a very bad thing, but junk bond means it's just very risky bond, risky. And there's no point in putting your money in a risky bond because if you are going to take that much risk, you would rather put your money in the stock, right? And so the junk bond class would have wide variance in the price around the rational price or the fair value. Again, the reason it is called rational price, the reason why it's called rational price is simple because all the future cash flows are rationally expected, right? Coupon, there's nothing else. It's only what other cash flow can be generated from this bond? There are only two types of cash flow to be generated from this bond: coupon interest, and at the end, the face value, right? So to find this, you will everything must be known. Everything in the right-hand side, must be known. To find the left-hand side, everything in the right-hand side must be known. In other words, so the left-hand side, bond price is the unknown, and then payment is known, N is known, face value is known, and then discount rate is known. Okay? Discount rate is known, R is known. Okay? Then we solve for, we can find the price of the bond, the rational price or intrinsic value of the bond. And in stocks, intrinsic value and actual market value can be quite different. In case of bond, that's why I said no, the variance is wide. In the short run, and I've been telling you over and over, in the short run, market is irrational. In the long run, market is rational, but in the short run, irrational. That's why there can be, that's why, something like Bitcoin can, it rose to like $60,000. Think about it. Bitcoin has no intrinsic value. Bitcoin has no intrinsic value. It's not based on anything. But stocks are not like that, Tesla, for example, although Tesla has a lot of bubble, still, but think about Apple or Tesla. I mean, if you are the shareholder, right? Your money invested. I mean, if suppose Tesla decides one day to close out the company, they close down. After many years, let's say we've had enough. We had good years, and we're not gonna continue anymore. So they close down the business. Then, when they close down the business, then shareholders can get their money back because if they close down the business, then they will shareholders will shareholders are the owners. What will they do to get their money back? They will liquidate all the physical assets of the company, right? All the physical assets of the company. I mean, whatever liquidity, the cash, whatever cash that the company has, it will be distributed to the shareholders, and the physical assets will be liquidated, right? Sold and distributed to the shareholders by the proportion of their shares, right? That's what happens when the company closes, right? If they have a debt, they will have to pay out the debt first, but whatever equity is left, they will distribute it across the every shareholder, right? But in case of Bitcoin, nothing like that. There's no fundamental, right? But anyway, the stock market is irrational in the short run because those who participate in the stock market, in other words, individual investors who just play stocks, right? Individual investors are average Joes. Most of the individual investors are average Joes, not highly trained people in finance and economics. So they don't know what's the intrinsic value. They don't know how to calculate intrinsic value. They just follow the herd, right? They play by. They have very thin ears, so they play by the ear, right? When they get some tip from someone, they act upon that tip, right? Then another day, another tip, so they sell it or buy it or whatever. They basically act upon this noise. They are noise trading, basically. Mm-hmm. Trading by noise. So that's why the market is so volatile. And in the short run, a lot of times, the actual market price will deviate from the intrinsic value. A lot. But I said in the long run, the market is rational. So in the long run, the market price will approach the rational price, but in the short run, it will deviate from the rational price. That's why there's a profit opportunity, because that means market is, in the short run, most of the time mispricing the asset. Okay. Of course, there's a school or camp that says market price is highly efficient, so it is the market price is the intrinsic value. Now, that's just one hypothesis. Okay. Information, efficiency theory, and if they say price is strong form efficient, information wise, that means price is exactly, market price is the rational price. But reality, no, market is not strong form efficient. It is, in a way, semi-strong form efficient, semi-strong form, which means, a lot of times market is mispricing. Yeah. So think about it. Tesla is mispriced, right? It's overpriced, actually. Mispricing means underpricing and overpricing. Tesla is most of the time overpriced. Bitcoin is overpriced, really, because there's no, underlying asset. It's got no fundamentals. There's no underlying asset to Bitcoin. And during the good economy, the market is overheated. As the market is overheated, then that means most of the assets are overpriced, right? But that's the case of stock. But I'm telling you, I've been telling you, in case of bond, it is relatively, that mispricing, the variance of the mispricing, the range of mispricing is relatively small. Most of the times it is, near the correct price. But the point is, if we find the rational price or the intrinsic value, right, then everything in the right-hand side is known. But sometimes when you buy a bond or stock, right, then you will have to pay the market price. So this is what symbol I use as the market price. Then market price is not unknown. Market price is a known value, isn't that right? Because it's something you just you look it up. Something you can look up in the Yahoo Finance, or in the print media or online media. You can look it up, and in that case, the price may be exactly the rational price or intrinsic value, or not, because in equilibrium, they're supposed to be the same thing, right? Market price and intrinsic value must be the same thing. But in the short run, market is not in equilibrium in the short run most of the times, and there will be a slight mispricing. So in that case, this, whether, think about it, even if the bond is overpriced, if you have to buy it, if you want to buy it, you have to pay that price, right? You cannot say, huh? Did someone say something? All right. So if you want to buy it, you cannot say, oh, it's overpriced. I will wait until the price is correct. Well, then you cannot buy that bond at that point. You will, and if you wait, the price may move away from even further from the intrinsic value. Or sometimes you may be lucky, and you may be you may find it at the point where the price is in equilibrium. But most of the times, whether if you want to buy it, you will have to pay this price. But once you pay this price, then there will be this price must be the result of discounting all the future cash flows to present, right? But then when this is known, there's only one thing unknown. In the right-hand side, think about it. There's only one number, one value. There's only one discount rate. There's only one discount rate that will make the right-hand side equal to the left-hand side, right? You don't have, it's not multiple choice. There can be only one number, right? That can make, and this number is the yield. In other words, you discounted by this number, this discount rate, which is the prevailing rate in the market, which is the average of what other comparable bonds of the same risk class are paying, right? And that mathematically, it is called internal rate of return. Internal rate of return. Internal rate of return is the rate, the discount rate that makes the right-hand side equal to the left-hand side. Okay. Of course, this is the half-year rate, so I'm using a lowercase y. But for annual, if you annualize it, it's called yield to maturity. So yield to maturity is the long-term yield. They say yield to maturity is the long-term yield, meaning that's what you get. That's your annualized return if you hold it to maturity. Also, it is what the average of what the comparable bonds are paying, right? Comparable bonds are paying, and also that is the remember the bond is yield price to yield something. The bond is price to yield something, and I said that's one of the ways it is worded, right? One of the ways the discount rate is worded, right? The bond is priced to yield something, right? So that's that something is the yield. So the part 2 of that problem was current yield. What's the current yield? In this case, yield is already given as 10%, right? Current yield in the short run. So I said if the yield to maturity is the long-term yield, then what is the short-term? In other words, if you're holding the bond on the 1 year, right? So then if you are holding the bond, or even if you hold it longer, but if you want to just calculate short-term 1 year return, what would you do? That short-term return is called current yield. The current yield is nothing but annual coupon payment over price of the bond, the price that you paid for, right? Price of the bond. Or even if you haven't bought it, if you're buying it now, the current price of the bond. Why? Because what is the maximum cash flow you can get from holding it for 1 year? What is the maximum cash flow you get from holding a bond for 1 year or less than 1 year? Anyone? Isn't it obvious? The maximum you can earn is annual coupon. If you're holding it just for 1 year, the maximum cash flow, right? Maximum cash flow from holding the bond is the annual coupon. right? So that's why you divide annual coupon by the current price of the bond. So then this question is easily answered. Current yield, which is the short-term return, current yield, maximum annual coupon payment is either this times 2 or I can do future value times coupon rate, right? Divided by the current price. This is the current price. Hit enter. 9.14. Okay, so everyone got this right. Everyone got this number. Everyone got this number. Now we're out of time. The class it's already 51, but let's just do this. In this example, this is the selling price, the current market price, selling price. So current market price is given. Market price is given. Everything else is given. Payment, time, all given. So then yield, right? We need to find yield to maturity. Half year rate. We'll need to find half year rate first. We use rate function. Okay. Give it what it's asking for. End period. There you go. Payment. There you go. Present value. There you go. It's already in negative because it's cash outflow. It's already in negative. You just enter it. And the future value. This is the future value, right? And hit. You already get this. Hit enter. Comes to this. Then that times 2. I will give you the yield to maturity. Okay. All right. So this is the that wraps up everything for today. Any questions? Any questions? Khalid, do you have any questions? Khalid?
No, I don't have any questions, but next class is
Okay.
gonna be in person, right?
Right. Next
Okay.
Monday in
Perfect.
person.
Are we
Right?
what are we gonna do?
I already assigned at the beginning of the class. I talked about the reading and videos I assigned.
Yeah.
Okay, so please watch that
Okay.
and read it. Okay.
Mhm.
All righty. So have a great afternoon, everyone.
You too, Professor.
I'll stop. Yeah. I
You
will see you
too.
guys. All right. Take care,
Okay.
everyone.
Thank you.
Take care.
Bye-bye.
Take care now. Bye bye. Have a great afternoon. I'll stop sharing, stop recording, and sign out.